Today, our topic is long-term capital management. So, what is Ltcm? First, let's make sure what is hedge funds. So, what is the definition of hedge funds? A hedge fund is basically a fancy name of an investment partnership. It's the marriage of a fund manager, which can often be known as the general partner, and the investors in the hedge funds, sometimes known as the limited partners. The limited partners contribute the money, and the general partner manages it according to the fund's strategy. The hedge fund's purpose is to maximize investor returns and eliminate risk, hence the word hedge. If these objectives sound a lot like the objectives of mutual funds, they are, but that is basically where the similarity ends. Now let's talk about what is the characteristic of hedge funds. Let's begin with the liquidity. Hedge funds are illiquid. One key characteristic of hedge funds is that they are illiquid. Most hedge fund managers limit how often investors can take their money out. A fund may lock in investors for 2 years or more. In other words, investing in a hedge fund is a long-term proposition because the money you invest may be locked up for years. The second one is open to accredited or qualified investors. Investors in hedge funds have to meet certain net worth requirements to invest in them. Net worth exceeding $1 million, including their primary residence. The third one is hedge funds have little to no regulatory oversight. Hedge funds don't have to register with the United States Securities and Exchange Commission, which is SEC. Most funds have their managers also are not required to register with the Financial Industry Regulatory Authority or the Commodity Future Trading Commission, the major self-regulatory bodies in the investment business. However, many funds register with these bodies anyway, choosing to give investors peace of mind and many protections otherwise not afforded to them, not including protection from losing money, of course. Whether registered or not, hedge funds cannot commit fraud, engage in inside trading, or otherwise violate the laws of the land. When it comes to the fee structure, instead of charging an expense ratio only, hedge funds charge both an expense ratio and a performance fee. The common fee structure is known as 2 and 20, which is a 2% asset management fee and then a 20% cut of any gains generated. The next characteristic is hedge funds use biased performance data. What gets investors excited about hedge funds is that the funds seem to have fabulous performance at every turn, no matter what the market does. But the great numbers you see in the papers can be misleading because hedge fund managers don't have to report performance numbers to anyone other than their fund investors. Those that do report their numbers to different analytical, consulting, and index firms do so voluntarily, and they are often the ones most likely to have good performance numbers to report. Add to that the fact that hedge fund managers can easily close shop when things are not going well. After it shuts down, it doesn't report its data anymore, if it ever did. and poorly performing funds are most likely to close. What all this means is that measures of hedge fund performance have a bias towards good numbers. The last one is hedge funds are secretive about performance and strategies. Some hedge funds are very secretive and for good reason. If other players in the market know how a fund is making its money, they will try to use same technique, and the unique opportunity for the front-running hedge funds may disappear. Hedge funds are not required to report their performance, disclose their holdings, or take questions from shareholders. After having a clear understanding of what is hedge funds, now let's do the summary of LTCM. In 1994, John Meriwether, the famed trader from Salomon Brothers Fund, founded a hedge fund called Long-Term Capital Management. Meriwether assembled an all-star team of traders and academics in an attempt to create a fund that would profit from the combination of the academics' quantitative models and the traders' market judgment and execution capabilities. Sophisticated investors, including many large investment banks, flocked to the fund, investing $1.3 million at inception. But 4 years later, at the end of September 1998, the fund had lost substantial amounts of the investor equity capital and was teetering on the brink of default. To avoid the threat of a systemic crisis in the world financial system, the Federal Reserve orchestrated a $3.5 million rescue package from leading U.S. investment and commercial banks. In exchange, the participants received 90% of long-term capital management's equity. Now let's have an overview of long-term capital management. LTCM seemed destined for success. After all, it had John Meriwether, the famed bond trader from Salomon Brothers, at its helm. Also on board were Nobel Prize-winning economists Marion Scores and Robert Merton, as well as David Mullins, a former vice chairman of the Federal Reserve Board who had quit his job to become a partner at LTCM. This credential convinced 80 founding investors to pony up the minimum investment of $10 million apiece. LTCM's main strategy was to make convergence trades. These trades involved finding securities that were mispriced relative to one another, taking long positions in the cheap ones and short positions in the rich ones. There were four main types of trade: convergence among United States, Japan, and European sovereign bonds, convergence among European sovereign bonds, convergence between on-the-run and off-the-run U.S. government bonds, long positions in emerging market sovereigns hedged back to dollars. Because this difference in values were tiny, the fund needed to take large and highly leveraged positions in order to make a significant profit. At the beginning of 1998, the fund had equity of $5 million and had borrowed over $125 billion, a leverage factor of roughly 30 to 1. LTCM's partners believed, on the basis of their complex computer models, that the long and short positions were highly correlated, and so the net risk was small. After having the basic knowledge on hedge fund and know what happened on long-term capital management, now let's do the critical analysis, which is based on the respect or violation of the CFA Code of Ethics and Standard. In general, we think that the reason of Ltcm's clubs is that they will not respect to some standards, especially Standard 3 duty to clients and Standard 5 investment analysis, recommendations, and actions. What's more, moral hazard problem existed as well. So now let's break them down. For Standard 3 duty to clients, the first one is loyalty, prudence, and care. Ltcm was taking too much risk for more performance and thus to collect more performance fees. This is not a prudent investment. In addition, in our opinion, Ltcm gave money back to investors at the end of 1997 because investment opportunities were not large and attractive enough, which holds a different opinion as the previous video, like the trial for the model. The next one is no disclosure regarding the strategy. Ltcm promised high return with the high risk taken. That is to attract more investors and thus collect more fees even if they didn't achieve the promised performance. Due to the lack of transparency, we cannot separate the fund's interests from the client's interests. After the massive losses, Ltcm did not allow existing investors to withdraw more than 12% of their money before a specified date. When it comes to suitability, they did not disclose information about their strategy and thus the level of risk. So, clients did not know what they are investing in and if this level of risk is suitable for their situation. In the video of 2015, they only mentioned that the exposure of pension funds to hedge funds is bad because it exposed ordinary people who have no financial knowledge to high-risky investments. However, we believe that it also provides diversification for pension funds portfolios, so for us it is a fair risk-return relation. For performance presentation, Ltcm did disclose their returns to their investors, but not in a complete way. That is, they did not disclose information about what kind of investments they took to make these returns. Due to the lack of regulations, Ltcm wasn't obligated to disclose their performance to outsiders, but only their investors. The final one in this standard is preservation of confidentiality. Ltcm and hedge funds in general did not disclose information about their investors to the public. They respect the privacy of their investors. That is, they don't disclose information about the name of their investors or the amounts they invested without their permission. We also think there were violations on Standard 5, investment analysis, recommendations, and actions for Ltcm. The first one in this standard is diligence and reasonable basis. One biggest reason of the failure of Ltcm is they relied too much on their model and the absence of human judgment. Their model was based on normal market conditions, while it became volatile in 1998, so it had to be adapted but retrusted their model, which kept telling them to hold their positions, while the market conditions were pointing that they should liquidate their positions. The issue of keeping the strategy secret did not allow investors and stakeholders to make appropriate due diligence before investing or making any kind of relationship with Ltcm. Also, it is obvious that Ltcm did not respect the communication with clients and prospective clients. Ltcm didn't disclose information about the investment strategies and the process they use, also the risk and the limitations associated with their models. The last but not least, the moral hazard. The Federal Reserve and the major banks in US intervened to bail out the Ltcm after making huge losses and taking over its management, which is 90% of Ltcm's equity. This rescue shows the issue of too big to fail. That is, whenever a big institution in the market is failing, the central bank comes for rescue, which encourage big institutions like hedge funds to take more risks, knowing that there are someone behind that would come for rescue if they fail. Which makes us a question on the intervention of central banks to rescue these institutions. Is it really necessary? After this critical analysis, there is also a lesson to be learned from the Ltcm's clubs. Market values matter for leveraged portfolios. The lesson learned from this case spoiled some of the supposed free lunch features of taking liquidity risk. This place can indeed generate excellent risk-adjusted returns, but only if held for a long time. Unfortunately, the only real source of capital is that to be patient enough to take fluctuations in the market values, especially though crisis is equity capital. In another word, you can take liquidity bets, but you cannot leverage them much. The second one is liquidity itself is a risk factor. Ltcm fell victim to a flight to liquidity. This phenomenon is common enough in capital markets crises that it should be built into risk models, either by introducing a new risk factor like liquidity or by including a flight to liquidity in the stress testing. The third one is models must be stress tested and combined with judgment. Another key lesson to be learned from the Ltcm debacle is that even or especially the most sophisticated financial models are subject to model risk and parameter risk, and should therefore be stress tested and tempered with judgment. While we are clearly privileged in exercising 20 for 20 hindsight, we can nonetheless think through the way in which judgment and stress testing could have been used to mitigate, if not avoid, this disaster. At the end of this video, we also give you our recommendations from Ltcm's clubs. The first one is stress testing. Ltcm, even other institutions, should test their models under extreme conditions. For example, according to the complex mathematical models used by Ltcm, the positions were low risk. Judgment tells us that the key assumption that the model depended on was the high correlation between the long and short positions. Certainly, recent history suggested that correlations between corporate bonds of different credit quality would move together, which is a correlation of between 90 to 95% over a 2-year horizon. During Ltcm's crisis, however, this correlation dropped to 80%. Stress testing against this lower correlation might have led Ltcm to assume less leverage to taking this bet. The second recommendation is more regulations and transparency. After the last crisis, the hedge funds industry was a little more regulated, but it is not enough. We believe that if the regulators were to intervene to regulate this alternative investment, it would be a huge step since it would be a more attractive asset class. So that's our analysis for Ltcm Club's case. Thank you for watching.